Regular watchers of this channel will know that most of the money that we invest in the stock market is done so using exchange traded funds, more commonly known as ETFs. But why do we rave about these awesome financial products so much? And why do we put so much of our money into ETFs over other investments such as stocks, bonds, or even traditional funds?
We think that ETFs have contributed to much of the improved accessibility of investing in recent years due to their extremely low costs and transparency. The first ever ETF was launched as recently as 1993 in the US, and it took another 7 years for the first ETF to be listed on the London Stock Exchange.
Since then, money has been pouring into these products, and for good reason. They're awesome! You may have seen our video series on how to own the world, where we essentially bought into every single major listed company in the entire world. We did it with these little beauties. In this video, we're going to look at the many reasons why we love ETFs so much. Let's check it out.
Welcome to Unshackled.com, the investing channel and website that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, hit the like button and click subscribe.
Don't forget to check out the Unshackled.com offers page, where we have hundreds of pounds of cash bonuses that you can snap up when you sign up to any of the stock market and peer-to-peer lending platforms listed, including sign-up bonuses on platforms that trade ETFs, Nutmeg, Free Trade and Trading 212. We'll put this link to the offers page in the description below, so be sure to check that out. Let's get into the video.
What is an ETF? We'll get into the many reasons in which ETFs destroy other investments shortly, but first, what is an ETF? An ETF, or exchange traded fund, is simply a fund which is traded on a stock exchange similar to that of a share. Most ETFs will track an index in an attempt to mirror its performance.
An index is a measurement of a section of the stock market like the FTSE 100 or the S&P 500. The FTSE 100 is the index comprised of the top 100 companies that are listed on the London Stock Exchange. These companies are often referred to as blue chip companies, and the FTSE 100 is traditionally seen as a good indicator of the performance of the UK economy. Here in the UK, whenever you hear about the stock market on the news, they will be referring to the FTSE 100.
An ETF will allow you to mimic as closely as possible the performance of the index. So, a FTSE 100 ETF should pretty much return the same return as the largest 100 companies in the UK.
This is awesome, particularly for small individual investors like ourselves, because we don't have to worry about stock picking or a fund manager's performance. We can sit back, relax and get some awesome investment returns for an incredibly low fee.
There are a number of ETF providers in the UK, the most popular being iShares and Vanguard, both of which offer numerous ETFs, which you will be able to buy and sell through any decent investment platform.
Some other providers include Xtrackers, SPDR, HSBC, LNG and WisdomTree, just to name a few.
Just to get a taste of how much money is invested in ETFs, the iShares S&P 500 ETF itself has assets under management of over $40 billion.
Why ETFs destroy other investments. Number 1, access to your money. You can sell at any time during market hours, but of course the price you get will depend on the market conditions at the time. But unlike traditional funds such as OICs and unit trusts, ETFs offer minute by minute pricing because they trade on an exchange, very much like a stock. This also means that when you buy an ETF, you know the exact price that you will pay, but this can't be said for when you buy a traditional fund such as a unit trust. This is because when you place an order for a traditional fund, you don't know the price you will pay until it is executed. The price may have changed during the day.
This can even make ETFs more appropriate for investors who trade more frequently, but we of course advocate long-term investing. The live prices of an ETF make them superior to open-ended funds in this regard because you can access your investment immediately. OICs and unit trusts only have daily prices and orders are only processed daily. By the time you can get your money, the price may be lower than what you would be happy with.
Number 2, diversification. Just one ETF will give an investor enormous diversification that just isn't possible when you buy individual stocks. In a single purchase, you can, with some ETFs, gain a position in thousands of stocks and/or bonds. Diversification is key for spreading risk and is considered essential in the world of investing. As we mentioned in our World Portfolio series, we advocate owning the world, and ETFs are the easiest way to achieve this.
Some people criticise diversification, but in our opinion, only a fool doesn't diversify to some extent. Individual stocks often fall and then never recover, whereas this can't be said about the whole stock market. The market has periods of decline, sure, but over the long term, it goes in one direction, and that is up. You can invest in the entire market using some ETFs.
Number 3, lower fees. ETFs that are passively managed have far lower fees than managed funds. A managed fund has to pay an expensive investment manager and trades more frequently, so therefore has higher costs. This portfolio turnover increases the transaction costs that a fund incurs, which is obviously passed back to the investor.
We at Money Unshackled like to keep our investment fees down to an absolute minimum, and some ETFs have almost non-existent fees. Take the iShares FTSE 100 ETF for example. Its ongoing charges fee is almost non-existent at 0.07%. That would be a fee of just £7 on a £10,000 investment. There is also no stamp duty when you buy an ETF, whereas when you buy an individual share, UK stamp duty is 0.5%. These charges don't sound like much, but they really do add up when you build and rebalance portfolios, and the effect compounds over time.
Number 4, huge choice. There are literally thousands of ETFs to choose from. You're bound to find one that you can invest in that matches what you're trying to do. Our preferred approach is to build a core portfolio consisting of ETFs that track the world market.
We then like to supplement it with additional investments that we feel give the portfolio a little boost, such as REIT ETFs, or ETFs for investing in smaller companies that we think are going to have better growth. For inspiration, a good tool to use is the website justetf.com, which is a very useful ETF screener, allowing you to filter down until you find an ETF that you like the look of.
Number 5, transparency. When we construct a portfolio, we like to know what we are investing in, and because ETFs track an index, they are totally transparent. You can easily see what the underlying holdings are. But this just isn't the case with managed funds. Usually you can only see the top 10 holdings.
This is a major problem because how on earth can you know what your exposure is? If you invest in 10 different managed funds and each one invests in some of the same shares, you could end up massively overexposed to one company.
When you make any investment, you need to understand it. But how is this possible when you don't even know what a fund is invested in? All of this is why ETFs are so damn awesome.
Question of the day. Do you agree with our views on ETFs? Or do you think there are better ways to invest? Let us know in the comments below.
Thanks for watching! On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
Visit moneyunshackled.com. See you next time.